All right. Well, welcome into our fourth and final segment of our Index Universal Life Sales Academy. Welcome to the end of the journey, but really the journey is just beginning for all of you on here. The whole purpose of this was so that you understood the working parts of Index Universal Life policies and to get involved in Index Universal Life sales. It's a fast growing segment of the life insurance marketplace. So get on board with that. We've talked in our part one, we talked about just dipping our toe into Index Universal Life sales, kind of just giving you kind of the lay of the land. In part two, we talked about how to position Index Universal Life sales with your client. And we showed you how to do it for the individual looking for family protection, as well as people who are looking to protect their business, whether it's a buy-sell agreement, key person policies, the golden handcuffs, which is to recruit, retain, and reward top talent. Last week, we talked about handling the Index Universal Life skeptic. People, even us as people who do sales, how some of us are skeptical. When I got into the business, I came into the business about 25 years ago, and that's when a lot of us were in that position of trying to rescue universal life policies because they didn't have those guarantees. Fast forward, how do we sell products that don't have that age 100 or age 120 guarantee? We talked about that. Now, this week, we are going to be talking about the Index Universal Life position, the portfolio. One thing that I want everybody to remember, write this down. Ameritas is a mutual company, which means they are always looking for the long-term relationship with their policy holders. And I will let Dylan and I will let Kevin kind of address all of that as we go on to this. So let's meet the experts again. We brought on Dylan Krings, who's the Regional Vice President of Ameritas, and Kevin Baytrip, who has, since we started this to where we are today, he has now been promoted to Regional Sales Manager. Congratulations, Kevin, on that nice accomplishment and that promotion. And hopefully they're paying you the big bucks. As your agent, I do want to, I take 10%, but we can negotiate that afterwards. But welcome in, guys. Again, thank you very much for doing this and really kind of taking URL and our agent partners under your wings on navigating Index Universal Life. So last week, Dylan and I, we were talking about the history of cash value life insurance, where it went from whole life, universal life, Index Universal Life. And we talked about participation rates. What does that mean? What are caps? What are floors? How to properly fund Index Universal Life policies, and how to perform a stress test to make sure that what you're looking at, comparing apples to apples, how to stress test Ameritas against any of the other policies out there. And then, of course, where my goal for everybody is being able to quote it with confidence, present it with confidence. So now let's talk about the Ameritas IUL sales success story. And I'm going to bring Dylan and Kevin in now, and I'm just going to roundtable discussion it and say, my first question is, what makes Ameritas unique in the IUL marketplace?
Dylan, you want me to take this, or do you want to start it?
Yeah, say, Kevin, I'll let you lead off here, and I'm going to go off camera to make sure I am not choppy with my connection. So go at it, Kevin.
Awesome. Well, yeah, I'll say just one thing pairing with our mutuality as a company. What makes us unique is that we're very conservative when it comes to illustrating. A lot of people in the industry, they want to spreadsheet well. They want to make their salespeople's jobs a little bit easier. But we like the challenge here at Ameritas. We want to show you that, it's not all about just the illustration. If you sell off the illustration, you're doomed to fail at some point. So it's all about unique features, how the companies perform, and that's something that Ameritas does well. We are very transparent with our returns, which is something that most companies are not. It is 3 to 4 clicks away for you guys to find our credit history rates. And those aren't look backs. Those are true crediting rates from our sweep dates. So that's the first thing. The second thing is that we pair that under promise, over deliver illustration with a rider called the lifetime income rider, which is not unique to Ameritas, but if I'm going to say, let's use the other two companies I know off the top of my head that have it. National Life has a lifetime income rider. They play a lot of games in the illustration market that we just don't play. So they boost their illustration to perform better on paper than what you're probably going to see when you get to returns. And then we have Corebridge or AIG, whichever one you want to call it, whichever one they're going by now. You can see they actually are historical cap cutters. So that not only are they going to play the illustration game, they're going to more than likely drop your cap rates on in-force business while still giving new cap rates that are really high to new clients, essentially rewarding different pools of money. So we don't do that at Ameritas. We're very conservative. We could pull triggers and pull levers to make our illustration look better. We don't. We want you guys to look like heroes when you undersell something and over deliver. And that lifetime income rider, having a guaranteed form of income that you can't outlive, is a solid piece to what makes Ameritas unique.
Yep, and Kevin, I think you hit it on the head, so I will not say repeat each one. We'll make it easy, but the consistent cap rates, that's a big story. You guys will see our oldest IUL from 2011 versus our current IUL for clients sold yesterday. Cap rates are basically identical within 0.25%, so equal treatment. And one other thing I'll say before moving on, uniqueness. We at Ameritas, we'll talk about it in a moment. Some of the most living benefit triggers you'll see in the industry at 18. The way we pay living benefits is unique also. So we'll be getting into that shortly.
Yeah, I can't wait to tell the living benefits story. That's going to be a lot of fun. One of the things that I have noticed in working with Ameritas in my time is that it's about relationships, and they rely on having relationships with URL, with the advisors that partner with URL, because they rely on you to tell the Ameritas story. And it's about making those recommendations. And really, it's throwing the sales concepts, the sales ideas out to the client. They trust you as their advisor. And it's just a great story. And just like Kevin mentioned, it's about making you look like the hero, under promise, over deliver. So, guys, you have two very popular IULs in the marketplace, and we're kind of keeping New York out of the conversation, although you do business in New York as well. But the two popular IULs is the Growth IUL2 and the Value Plus IUL. So, kind of give us a description of what each plan does. There's two different functions or two products with different targets, different functions. If you can explain that, and I'll put on the next slide here so that you can kind of explain that as we have that visual here about the differences.
Awesome. Yeah. Well, I'll go ahead and no need to worry about New York. Both of these are available in New York, so you don't even have to worry about it. So I'll start off with the Growth versus the Value Plus. I want to say it right now, our naming conventions at Ameritas are pretty nice. If you ever see Value Plus, no matter what product it is, you can assume it's the cheapest product with that name that is going to get you a death benefit for that price. So we have a Value Plus Whole Life, an IUL. We're going to cover the IUL today, which is honestly one of my favorite products at Ameritas, because I think we mentioned it, maybe just teased at it the first time we talked about a little bit about product, is that this is an all-in-one. So you can design it as a kind of like a GUL hybrid policy with an IUL chassis. And the reason that makes it so good is that if you guys know, if you're in a GUL, if your client switches down the line and says, actually, I don't need the death benefit, they switch their plan completely and want cash, they're more than likely handcuffed there. Or they're going to have to move to a new policy, less insurability. They're older now. It's just not going to look as good. Whereas with our Value Plus IUL, you built it on a guaranteed chassis of age 90, but you switched your plan later down the line. And guess what? It has the lifetime income rider built in automatically. So we can see, not only can we take loans from this policy, whatever cash we've accumulated, we can say, okay, give me a guaranteed income for the rest of my life. We built it as a death benefit play. So it's a great hybrid policy that has an all-in-one, and it also has the living benefits. Whereas we switch to that Growth, it's really focused on your accumulation. It's the one where you don't care as much about guarantees. It's that conservative investor that wants to get a lot of return, and they don't want to pay the guaranteed whole life price, and they want the upside that an IUL brings. That's what the Growth IUL does.
Yeah, Kevin, very good points. And I think just to add on to that, as the product name says, if you look who it is optimized for. So Value Plus, think protection. The Value Plus IUL, that is actually our cheapest permanent product at Ameritas. You can lock in guarantees to the age of 90 or 50 years, whichever comes first. So that's our protection IUL, growth IUL. Just think like Kevin said, long-term growth is the focus. What you guys will see between the growth versus, or let's say our accumulation versus our protection IUL. The protection IUL cap rates are about 2% lower. So as the name implies, the growth potential not as high, but it's going to be a death benefit focused product. And last thing I'll mention, on the growth IUL product on the left-hand side, it does say the ages are typically 35 to 55. This is also a children's IUL. So a few weeks ago, we talked about kids IULs. This is for college planning. You can start this off with Ameritas. 14 days old is the youngest a client needs to be to get an IUL plan. So this is great for college planning as well. So you have those different options, accumulation and protection.
Yep. You mentioned about the lifetime income benefit that's in there. Is that basically annuitizing the cash value?
You nailed it right on the head. Yep. The annuitizing.
Okay.
So if you were to die the first year after you do it, you didn't lose too much money. You only lost what you took out in the form of like a withdrawal or annuitization. So you got it perfect.
Perfect. Awesome. So part of the Emeritus IUL story and about an index universal life plan is that people have the ability to choose different market indexes or indices. So you offer different fund selections. What are they? And what would you say are your most popular selections when people are making those fund choices?
Yeah, so this is a big one for Ameritas. This also kind of plays with what makes us a little unique compared to the industry. So AG49A and B say that you should be allocating and defaulting to the S&P 500. We've seen that that's one of the easiest games to play is to just automatically default to a volatility controlled index. It also helps the companies because volatility controls, shocker, are a lot cheaper than the S&P 500. So it helps the companies. But here at Ameritas, we say we want to we default you at the 500 because it's the easiest thing when you're selling an IUL. IULs are already confusing enough as they can be with all the smoke, mirrors, and what you can find behind it. But we default to the S&P because most people know the S&P 500 and can rely on it to give them a solid return over the next 15, 20, however many years. That being said, we also added some new stuff within the S&P on these that are very attractive. They're volatility controlled, so it's the S&P sector rotator. That simply works with the 11 sectors of the S&P. Every 6 months, it cycles down to the top 5. And then from that top 5, it chooses the top 3 in price momentum and sets that for the next 6 months. And then guess what? Free of charge, Ameritas does it again. The next 6 months does that same cycle. And then the Mark 5, if you guys have worked with annuities before, you've probably seen the Mark 5. So I'm not going to explain it too much in depth, but just know it's another option that's uncapped, high par, so you can get a little bit more earning potential. And then the BMP is a proprietary to at Ameritas, and it is a volatility control that's good. It's kind of had some down years, but all of those are good hitters if you want to earn a little bit more money. The one thing I am a little bit sad about on the growth is that it does not have the Russell. I'm a big supporter of the Russell S&P 500 mix. I don't give advice, but that's my personal preference. Obviously not licensed, but most of the time what we see people use is some blend of S&P for the consistent returns that you can tell your client, something with a high par, low that's uncapped to give you that uninterrupted compounding interest that can get you no ceiling. And then some people, if you're really conservative, they'll put a little bit in our fixed because it's roughly 4%, which is a good fixed rate. So that's typically what we see. And I'm not going to touch the MSCI. We don't see people allocate to it too often.
Yeah. Yep. And Kevin say, I don't think I can say it any better. For the popular indexes, as Kevin said, the S&P 500, I think I see every IUL use that in some way, whether it's 50, 75%, possibly higher, and then blend it with some sort of uncapped. So keep in mind the S&P historically has averaged 10% growth. So with us, I think our cap right now is 9.5%. You're getting 9.5 if we hit that 10% or higher. So that's where we talked last week. You have those caps, but hey, in those down years, you have the floor. 0 is the hero. You're not losing money. if the client is very conservative or if they're feeling psychic, we're going to have a negative year and they want to guarantee a return, like Kevin said, you can guarantee the 4% fixed account. That's also an option.
Okay, awesome. And they have that annual select. They can make that selection each year. It's annual, right?
Yep, right at policy date. So you want to make sure you get it. You have it kind of set in place. Have your policy review, and then get them going in those new allocations.
Gotcha. Okay. Now, this is what I call one of the biggest differentiators in the industry, and that is Ameritas's living benefits. So let's talk living benefits. Go, take it away, guys.
Dylan, I'll let you go first since I've been hogging it. I know the story very well. So
no, thank you, Kevin. And guys, Kevin is sort of like our product pro with his IMO experience. So I love having him on here. He knows just a ton about our products and how they stack up. So glad he's here and leading off a lot of this. But living benefits, like we were saying, guys, and what Matt said, this is what I would say is one of our highlights at Ameritas. So if you're looking for like a top 3 story, we talk about the cap rate consistency, but then the living benefit story is big for us. So every product we offer, except our one traditional term product, every product we offer at Ameritas is going to come with 18 living benefit triggers, as long as the client is approved table D, as in dog or better. So sometimes there's exceptions. In my time at Ameritas, I've seen about a handful of cases where it's better than table D, where some living benefits get removed. But you guys can plan table D or better. They're getting the full suite of 18 living benefit triggers here. What you're going to see on all of our products when you quote them, the Care for Life rider is automatically selected. Simply put, that's our living benefit triggers. So you get the 15 critical, 2 chronic triggers, and 1 terminal illness being defined as 18 months or less to live. So Kevin, what would you say? Anything you would add to that?
Yeah, so I want to add 2 things here for our critical illness and then our terminal illness. For the critical, you can see there's a couple in blue here, benign brain tumor and coronary artery bypass. Those are unique to Ameritas, so we are the only company that covers that. And then there's also, including those 2, heart valve replacement, major heart attack, and stroke. Those are the top 5 historical payouts. So automatically, you're getting 2 extra ones that you're not going to get at another company. So we can cover the full 5. Other companies can possibly only cover the 3. Because they don't have the benign brain tumor and coronary artery bypass. So it is a big thing to think about, because if you can't access your living benefits through a trigger, they're just on a piece of paper. It doesn't help your client. So the more triggers you have, the more beneficial a policy can be to them. And then the final one is term illness. I want to kind of reinvent how this can be sold, because most companies have this, so this is not new. But a lot of people think of this as, kind of like a final expense. You're making sure that the family is taken care of. You're taking them on that vacation you never, got to go on, whatever it may be. I want to give a third option here, and that's for experimental procedures. They aren't covered by health insurance, so a lot of the times people can't afford to go get them. That being said, you can sell almost any policy that has terminal illness, so it doesn't just matter if it's Ameritas or not. Just for you guys to have in the back of your pocket, a terminal illness is very powerful, even though they're included on most policies, because you can go get that experimental procedure and hopefully extend your life just by having a life insurance policy. So again, that's the living benefit, because most people think, oh, I have to die to get it. No, actually, this could possibly save your life. And just because you had it, even if it was on the term, you now have extended your life. Instead of having 12 months, maybe you have 5 years, 6 years, whatever it may be, if the experimental procedure works. So something I think that a lot of people miss there.
I will tell you another thing that separates you on the terminal illness from other companies. Other companies, when it comes to the terminal illness, is that people can access the death benefit if they've been given a life expectancy of a year or less. The fact that you guys go 18 months is also pretty big. That's another great opportunity there, a great sales idea. I had a personal client of mine who he was diagnosed with terminal cancer, and unfortunately he took his own life. And when I was talking to his daughter, who was trying to figure out if there would be a claim, I explained to her that unfortunately there isn't, because it was within the 2 years that he purchased the policy. because of taking his own life. However, if he would have told us about the terminal illness, that he had a terminal cancer, they would have been able to accelerate some of his death benefit. But unfortunately, we didn't know, and he didn't talk to his family until after he was gone. But knowing that, have that conversation with your clients, letting them know that, things happen. You're insurable today, but let's say 6 months, a year, 2 years, 5 years from now, you come up with cancer or some of these other illnesses, you can access the death benefit to, like Kevin said, extend your life or go on that vacation that making those family memories, whatever it is. So those are all stories that you can tell. So how are living benefits paid? I know this is also very unique to Ameritas.
Yeah, I'll take this one, Dylan, because I worked with most of these companies. So I know there's a discount approach and there's a lien approach. We take both approaches at Ameritas because how you do a lien is you place a lien against the cash value and the death benefit. On terms, we don't have cash value, so we can't do a lien approach. So we have to do a discount approach on our term product. And the discount is essentially you get a higher percentage that you can pull from. You can see it's 90% here compared to the 75% for terminal on the other side. But what comes with that is it's a sliding scale. You never know exactly what you're going to get. With a lien, you know exactly what you're going to get. You're going to get the 75, the 50, and the 25. The discount, it depends on how severe your illness is, how long you have left to live after the claim, and some other factors. So you can tell, you can get 90% of that $1 million, but I can't tell you exactly what you're going to get. And the reason why that's an issue is that on discount policies, so let's just use other companies, they use these on their permanent products. That gets a little more concerning. And the reason why is, let's say for our product, we have $1 million. On our permanent product, you guys can see here, we're getting 50%. You're going to get $500K. You request $500K, you get $500K. You have $500K left over. If I were to do that same thing on the discount approach, let's say you actually have quite a bit of time left to live. The illness wasn't that severe. We'll give you $250. Guess what they're going to take that death benefit down by? The $500K you reduced it by. You requested that, so they're going to take it out. Even though you only got paid $250, your death benefit's going down by $500K at a minimum. Sometimes they'll discount it more and take the full 90%. So you don't know what you're actually going to be able to get from your policy and what's left over. Whereas on our permanent products, we take the lien approach. What you see is what you get. 50% out, 50% remaining, and you have a little bit of a lien on the death benefit and the cash value. We leave the account value untouched. I want to repeat that. We leave the account value untouched, and that is the most important part when we're looking at permanent products, because that's where all of your uninterrupted compounding interest in your indices is at. Other companies that use the discount, they take the account, the cash value, and the death benefit. And typically, that's a formula. Almost 9 times out of 10, I would say, your policy is going to lapse. And that's not why you got your IUL. You got it to have cash value. Using the lien approach allows you to build that back over time because we leave the account value untouched. I tried to explain that easy. Was that good?
That was fantastic.
Awesome.
That again goes to the point that I made earlier. They're a mutual company, and it's about longevity and having those long relationships with the clients. And again, under promising, over delivering. There's a great story to tell. And yeah, to Kevin's point, here at URL, we have a bunch of different companies that offer living benefits. A lot of them, it's that sliding scale. Like, you hope the policy's in force long enough and you've reached an attained age to get that benefit, and you hope that it checks off some of their boxes and you're going to get the most out of that benefit. But there's also a chance that, some companies will say you get up to 24%, up to 90%. I like here's what you get, and you can run with it. And it takes the guesswork out of it.
Can I pick on the 24% as well?
Yeah.
I'm going to say the name. They only have 9 triggers, so it's half.
Yep. Yes. So, I like that. That was named to be named later. So, what are some of the key attributes? We've talked about product. We've talked about we've talked about what separates Ameritas from everybody else. We've talked living benefits. Let's talk about the advisor again. And doing this for as long as I have, and I know you've seen advisors from all over the country, what are some of the key attributes that you notice that it takes? What are some key things that successful advisors possess that help them and excel in the IUL market?
It's kind of just finding where you fit and what makes you comfortable. So obviously, we want all of your guys' business, but realistically, we're not going to fit every need.
Right.
There's going to be some times where it's just going to make more sense. I'll use that same company. They have a cost alternative IUL. We don't. So they automatically will get that business. So it's just finding a company, and you guys work with URL, so you have a leg up here. They're going to be able to help you as well. A company that you enjoy working with, products that fit your client's need, and staying with those, because once you're comfortable and you can get in that rhythm, that's where you're going to see all your success come in. Because if you don't know what you're selling, you don't feel confident about it, that's going to make it automatic for those clients to step in and say, okay, well, I'm not comfortable with it. You guys need to be confident and comfortable with the products and the company. The company is also a big piece that people overlook.
Yeah, but I will add to what Kevin said, thinking of key attributes that I see some of the most successful agents, what they have, where I see them lead in IUL sales. You guys often hear throughout your lifetime, never stop learning. The agents do their due diligence. They look at different products and they really find out what makes this product different from company B, company C. And then they can make the best recommendation to their client. So you guys will study and learn different IUL products over time. And eventually you'll probably have a top 2 or top 3 that you rely on all the time.
Yep.
And I think the last thing I'll say with key attributes, learning is one thing, but last week we said telling is not selling. So build that emotional connection with your clients. Let them know how this product is going to benefit them. But to build that emotional connection, ask them questions. What would you do if you got sick 5 years from now? How would your client or how would your family be taken care of? What are your concerns in retirement? Do you want tax-free income? Are you worried about losing money in the marketplace? They're going to say many answers, and many of those answers you will have a solution for. It's the IUL. So keep that in mind as you guys are working with your clients.
Absolutely. Yeah, it's asking the right questions and finding out what keeps them up at night, and then trying to check off some of those boxes to give a better peace of mind for the client. That's what you're doing. That's what I think life insurance does, and it does more than anything else, is provides peace of mind. So this is a question about how advisors can take advantage of their relationship with Ameritas. So what are your recommendations to those advisors so that they get the most bang from their buck with their Ameritas relationship?
Yeah. So yeah, I'll start it off here, Kevin. I think, Matt, you said it at the start, this industry, it is really all about relationships. And we are, as a mutual company, Kevin talked about the relationships that we have with our clients, trying to do best by them. Our sales team, our new business underwriting team, we want to do best by you as our agent partners as well. So what I would recommend, build that relationship. You guys have that with URL, but always feel free to reach out to Ameritas as well. Our sales team wants to build a relationship with you. Having a relationship with your new business case manager, your underwriter, not a bad idea. So those are some big recommendations, just getting the most out of the Ameritas relationship. It will help, and you will notice that. And you likely have either with Ameritas or other carriers, So, that's a strong point to make.
Yeah,
I'll hop in here with something. Yeah, I'll hop in here something just real quick on that relationship. We actually give you guys a discount on your own personal policies. Just wanted to give the heads up there. It's 4% discount. Typically costs about 20% in commissions. I did this with someone from another agency. Dylan actually knows this story all too well. She looked back at her policy. If she would have done the discount, which is just checking a button and working with Ameritas, it would save her. I think she would have lost $4,000 in commission, but would have had an extra $125,000 at retirement, which fair trade in my opinion. But yeah, it's for you, your spouse, and then immediate family members. And I say it never hurts to ask if it can be, on some extended family members. So yeah, just something to think about.
And Kevin, what was that discount called, just so they know?
Employee discount. Can't get any easier.
Well, we've kind of got to the end of the road here for our training. And there's about 4 or 5 steps for everybody's next steps here. And the first step is to contact me or contact our licensing team and request contracting with Ameritas. And folks, let me just say this, Ameritas pays very, very well. They're I don't want to tell Kevin and Dylan too much because I don't want them to go back to actuaries and everything else and say we're paying way too much in commission, but they do pay a very good commission. So they're at the top, if not in the mix there with everybody else. So keep that in mind. The other step is go back and watch all of these training videos, kind of like what Dylan said, be a student of the industry. Go back and review parts 1 through 4 on demand. We have them recorded for you so that you can go back and kind of pick up additional mind nuggets, things that you may have missed in the other parts. And then while you're doing that, compile a list of at least 5 people that come to mind that you want to sit down and talk to them about their wants, their needs, what's keeping them up at night. And then contact me. Set up a time where you can schedule it through my email. You can schedule it on our website, and I'll call you and we can talk about those clients and we can customize a case for them and how to approach a person about Index Universal Life. And then the other step is to present and close. You're not gonna bat 1,000. You're not gonna get every person that you talk to, but it's about having those conversations and just getting out there and building that confidence. You're going to get told no a handful of times, and you're also going to hear yes as well. And it's the yeses that are what pay your bills. But Wayne Gretzky said you're not going to hit 100% of the shots you don't take. You're not going to, something like that. Anyway, I just completely butchered it. Go out there and take the shot. So at this point, I want to take a couple of questions here. Ed, I know you asked about if we're going to do a series like this on whole life products. I know we're going to be doing some additional webinars with Ameritas in the very near future. We'll be working with Dylan and Kevin on getting some of those on the calendar. Perhaps we'll talk about doing a series like this on the whole life products. Ed also asked, and I'll throw this to you guys. He asks explain the 2 options on loans direct recognition and non-direct at Ameritas.
Yeah, so those ones are specifically tied to our whole life. When I think about that, essentially what it means is that we're going to see 90% of people taking the non-direct recognition. It's tied to a variable loan. And the reason why is because uninterrupted compounding interest. So when the company views the money when they're looking at your dividend and what they're going to pay you, if it's non-direct, they don't recognize, they don't see, is the best way I can kind of pitch this, is they don't see that you took a loan. Whereas if we took a direct fixed loan, they would see I took out $10,000. So instead of having $50,000 in my non-direct recognition, I'd have 40 in my direct because they see that you took 10 out. So you can see you're going to get less money on that direct recognition because it's 5% of whatever your value is roughly how to think about it. So that's the way to think. And then I will say, if you want to use a direct loan, the only way I can kind of see selling it is that it's a lower interest rate. So that's kind of the thing, because you're interrupting your compounding interest, but at least you're getting a lower interest rate. So those are the 2.
Okay, I appreciate that. If there's any other questions, please feel free to ask those questions. And again, this is where now the ball is in your court. You can make money. You have the training. You have the tools. You have the resources. And most importantly, lean on us here at URL. We're here to help you and help you make a compelling presentation, but it's up to you to come up with the people to see. Between me and the rest of the Life Markets team, we're here to help you, and we're here to make you look like a hero. So if you do have questions, my direct number is 717-216-8041. Email is matta@urlinsgroup.com. IULs.com. Dylan, Kevin, it has been fun. It's been a pleasure. And I look forward to seeing you guys at the Spring Sales Symposium in April. And I also look forward to a long relationship working with you guys. And, let's go out there and have some fun.
Absolutely. Thank you, Matt. Thank you, everyone.
All right. That's it for us here. Again, if you need anything, we're here. My number is 717-216-8041 or matta@urlinsgroup.com. Thanks, everybody, and make it a great day. Take care.